give me your attention, baby. I gotta tell you a little something about yourself. You're wonderful, flawless, ooh, you a sexy lady. But you walk around here like you wanna be someone else. Ooh, whoa. I know that you don't know it, but you're fine, so fine. Fine, so fine. Ooh,
This is Prince Dykes. This is Raw Financials.
girl, I'm gonna show you.
Today's topic is going to be option trading 101. I'm going to give you the basic or rundown crash course of option trading. If you don't really get it, or it may take a little time, but just send me a message. Just let me know what your question may be, and I definitely get right back to you. So another topic I'm going to cover as well is I'm going to tell you guys how I made 27% in about 2 days. So I'm going to give you a play-by-play, direct, screen captures, everything. So you can see the numbers, you can see everything that I said and the moves that I made. So let's get straight into it. So the first thing, let's get into option trading. Let's get into terminology, right? You have calls and you also have puts. Calls give you the right to buy a stock. Puts give you the right to sell a stock. So with that being said, how do people make money on this? So for example, let's say if a stock, for example, let's use Bank of America. Let's say Bank of America is trading for $14. And you say, hey, I think Bank of America is going to become higher in the future. And I think that Bank of America is going to go higher and it's going to go up to $20 in the future, right? So what you can do, you can go out and you can buy calls for maybe $16. So for example, let me show you guys here on my clipboard what I'm talking about. So boom, Bank of America is trading for $14, right? That simply is Bank of America trading for $14. You think Bank of America is going to go up to $20, right? So you say, hey, what a call is going to allow you to do, a call is going to allow you, let's say, let's put a 16 in here because you got 14, 15, 16, 17, 18, and 19. It's kind of small, but just, 14, 15, 16, 17, 18, 19, 20, going all the way up. So Bank of America is trading here, right? Bank of America starts here. And you say, hey, I think Bank of America is going to go up. So you can go in and you can buy contracts for, let's say, $16, right? You can buy a contract. One contract is 100 shares. It's 100 shares, right? So you can say, hey, I want to buy a contract. Contracts vary depending on expiration date, things like that. But you can buy a contract that can say, hey, I have the right to buy Bank of America at a such and such date in the future. So the price that you pick is called a strike price, right? And also you have to pick a date, an expiration date. So expiration date, you pick a date, let's say by December 5th, I have the right, my contract will be able to give me the right to buy Bank of America for $16 on December 5th, right? And if Bank of America, let's say November rolls around, Bank of America is trading at $19, right? You still have that contract that says you can buy Bank of America for $16. So 16 and 19, that's $3 per share. That right there, my friend, is, if you exercise it, is a $300 gain. So off of one contract. And that's how option trading works. This is called a call. A call gives you the right to be able to buy in the future. You think a stock is going to do well. You think it's going to go up. So let's look at the reverse side, right? The other side you have is puts. Puts give you the right to be able to sell something in the future. So let's say let's use Bank of America for again, right? Bank of America, BAC. This is the stocks symbol. So if you want to look up Bank of America, you look it up by this symbol. Every company has its own symbol. So that's Bank of America, right? It's $14. You're like, man, Bank of America is going bankrupt. I don't think it's going to do well. I think it's going to go down. I think it's going to go down to $8 in the future. So what you can say, what you can do is say, hey, I want to buy a contract. A contract is how many shares? 100. See, there you go. You're catching on already. So a contract is 100 shares, right? So let's say if you go down to, let's say in the future, you say this is your strike price. You pick the strike price at $10. I want the ability to be able to sell puts. This is what these are called, puts. They give you the right to sell. I want to have the right to be able to sell Bank of America for $10. That's your strike price in the future. So you buy one contract of Bank of America, and let's say you got to choose an expiration date. Expiration date, let's say you choose December 5th again. So that means for any time from now until December 5th, I can sell Bank of America for $10. So if the current price of Bank of America is $14, your contract is not going to be worth anything. It's actually going to be worth negative because people are going to say, hey, why do I want to sell it for $10 when I can sell it for 14? But you know something they don't know, right? So they keep going down. Bank of America goes down from 14 to 13, 12, 11, 10, 9, and now it's at $8, right? And let's say it's November. So you're like, hey, I have this contract that says I can sell Bank of America for $8. I mean, not $8, but I can sell Bank of America for $10. So 8 and 10, the difference between those is 2. You only had one contract, $2 per contract per share. I meant to say $2 per share is $200. That's a $200 profit. Now you guys couldn't see where I was writing down there, but I was just saying that one contract equals 100 shares. December 5th expiration date, 2 times 100. 2 times 100 is 200. So here, what I was saying was the stock went down. You brought the strike price of $10. You have puts that give you the right to be able to sell. That's a crash course. This is options. This is how people make money on the market. When the market is doing good, they can use calls or they can use puts. Or some people protect their investments with calls and puts. So this is a way you can make money in the market just by knowing what's going to happen. Now, me personally, what I do is I wait till the market come to me. I'm more of a passive guy. I wait to find news or when I think something's going to do well or good, then I can use option trading. When the market is doing good, I look for puts. This is a little bit more detail. I look for puts. When the market is doing bad, I look for calls. Because the price of calls go down, it's the reverse thing. Price of calls, the value and price of calls go down when the market goes down, and the price of puts go up. The market's going up. So that's the way I get into it. But I can tell you more into that later. But this is just give you a basic run through. Calls give you the ability to be able to buy, and puts give you the ability to be able to sell. And it's called option trading because you can either sell your contract, you can use that contract, you can do things like that. And how does this all work? How does it all put together? How can you buy a stock and buy contracts? Because there's people out there with the stock. You make an agreement with somebody else. The person said, you go to somebody and say, hey, let me be able to buy your, like I have Bank of America right now, right? Somebody come to me and say, hey, when Bank of America gets to $20, let me have the ability to be able to buy it. Okay, sure. They pay me that money. They pay me the premium. I keep that money. I put it in my pocket. But now, if Bank of America reaches $20, before that expiration date, that person can buy it. That's a quick crash course on Option Trading 101. You got any questions? I know that was kind of fast, but that's just a quick overview. You got any more questions? Just shoot an email or comment, share, whatever, inbox me. Whatever your questions are, hey, slow it down, make another video. I definitely will. I'll probably make another anyway. This one's kind of quick. So let's get on to the next topic. So what moves did I make? How did I make a 27% returns using option trading in 2 days? So I made a video a couple videos back. It was like 42% return on investment in maybe 3 days. So actually I made a 27% return, but if I'd have waited a little bit longer till today, it'd probably be about a 50 or 60% return. But I got a step-by-step video. I'm going to go through and show you exactly how I did it. And I posted this information on my Facebook page. So if you don't know where I'm at on Facebook, follow me on Facebook. Or you can just type in my web browser that you're going to see in my video anyway. So follow me on Facebook. I put out my information. I tell you what I'm going to do. And this is one of the things that I did. Stay tuned. All right, guys. So I'm going to start here off of my Facebook page. This is my Facebook page, Royal Financials. You can see the actual, address up here if you guys want to follow it as well, come in and hit the like button and you can be following us as well. So I'm going to start here just to show you guys that I put this information up. So right here on September, it has the date right here, September 15. I wrote an article that says, I put a little picture here. It says, great opportunity. Steve Roth resigns from JCPenney board, the second big investor to lead the struggling chain. Board is recent, blah, blah, blah. This could be a great chance to place a put. So this is what I wrote and I put up on September 15th on my Royal Financials page, right? I was saying that I thought that JCPenney was going to go down and should place puts. So here, it's here to give you guys a little. This is a little snapshot from my portfolio. I'm not going to put all my portfolio on there for privacy reasons, but this is just a little snap here just to show you the actual move I made. So I put that up on the 15th that you guys saw from my Royal Financials page, and this gives you the date right here. You can see the date here. The date is September 16th. Let me see, can I blow that up? Can I blow this up for a second? The date is September 16th, and September 16, 2013, which is the next day, I placed puts. JCP stands for JCPenney. That's a stock symbol. Its expiration date is September 27, 2013. I placed puts for $13.50. This is the next day, and one day, I brought them. This is the price I paid. What I'm circling right here, this is the price I paid, 35 cents per share for 10 contracts. This is how many contracts I brought. 10 contracts. One contract equals 1,000. No, one contract equals 100 shares. Since I had 10 contracts, 10 times 10 equals 1,000. So I have 1,000 shares. And one day it jumped up 55%, and it jumped up to 45 cents, leaving me with a rate of return over here. This is my overall return, 27.84 in one day. So on the 15th, I said, hey, I think JCPenney is going to go down. JCPenney went down that same day. I made a 27% return in one day. So this is just to show you guys. This is a snap from my portfolio to show the information I actually put out. And that's how I made on my particular end of making a 27% return in a matter of 2 days. All right, guys. Thank you very much for watching. All right, guys. I hope that was helpful. I gave you a detailed view of exactly what I did and how I was able to make money off of JCPenney going down. I hope that hopefully that helps you guys. I know it's a little bit hard to understand it, but thank you guys. Don't forget, like, share, subscribe to me, and thank you guys for your overwhelming support, and keep supporting me. Thank you.
Business in the AA, and I've been witness to this history ever since the 10th grade. We went from rock and brace to 10th phase. I twist my A head to the side just for style, or throw on the Gucci bucket with the fly super fly.